Welcome to The Value of Knowing, the podcast where we dive deep into the world of legal complexity and opportunity on the vibrant continent of Africa. Stay tuned for expert insights and a closer look at the legal landscape in Africa, where Bowmans helps its clients to manage legal complexity and unlock opportunity. That's the value of knowing.
As global investors increasingly turn their attention to Africa, understanding the nuances of remuneration management and governance in this complex, dynamic, and high-growth region is critical to manage the inherent people risks and opportunities which are key for sustainable success. My name is Norma Mazibuko, an integral part of the Bowmans Reward Advisory team. It is an absolute honor and privilege to host this conversation on significant trends and developments in remuneration on the African continent. This serves as a precursor to our inaugural Africa Remuneration Trends Report, which cuts across 6 key jurisdictions on the vibrant African continent. And today we are in conversation with 4 experts to unlock these complexities and track the evolution of remuneration management. Rainbow Field is the head of M&A and Director of Employment at Bowmans in Nairobi. Also introducing Ozofu Ogiemudia. Ozofu is a partner in our alliance firm in Nigeria. And Lenja Dahms-Jansen, a partner at Bowmans Reward Advisory in our South African team, who specializes in employment and benefits law, with a strong focus on the legal and corporate remuneration structures. And last, but certainly not least, the sage of reward, Martin Hopkins, the head of the reward advisory practice at Bowmans South Africa. So this inaugural trends report, it highlights significant trends and developments in remuneration practices, providing insights into how African companies are adapting to global standards while addressing local challenges. So with that said, I think as part of our conversation, it would be great to look at how reward and remuneration has evolved across our various regions that are represented this morning. Rainbow, perhaps you can take us through what's been happening in the Eastern Africa space from an evolutionary perspective.
In East Africa and more specifically in Kenya as well, over the last decade, we've seen remuneration change significantly. And the drivers have been economic, social, technological changes. In Kenya, we've seen quite large shifts in compensation structures, talent management practices, and the broader reward ecosystem as companies adapt to global trends and local challenges. So where we began over a decade ago, we came from a place with basic pay structures and some benefits being included, such benefits as cars, housing, some gym memberships for executives. But we've very much moved towards more of a performance-based pay and other incentive structures such as ESOPs, long-term incentive plans, specific bonuses linked to company performance. We've seen an increase in non-monetary benefits. So we're looking at wellness programs, mental health supports, gym memberships, which I mentioned, but we've seen a definite increase, as well as other benefits such as flexible working arrangements and support with career development. Some of the changes have also been linked to adapting to inflation and other economic shocks. So where we've seen responses to COVID-19, for example. And we've also seen an increase in the transparency related to pay practices. This is reflective across East Africa as well. A lot of it has been happening in Tanzania as well as Uganda.
So it's really that total rewards approach that we're seeing. Ozofu, I would imagine similar trends coming across from the Western African perspective?
Yes, indeed. Quite similar, but I think some of our challenges on this side of the continent and specifically in Nigeria have meant that some of the traditional forms of compensation still remain relevant. In Nigeria, we've seen an evolution from the times where the bulk of remuneration was contained in the monthly package to one where the most juicy of parts of the incentives are found in opportunities for lump sum bonus payments, as well as ownership opportunities for executives and the ability to structure for tax efficiency, as well as provide an opportunity for greater alignment between management and the company through an equity incentive in the company has proven to be a successful strategy, both for attracting the best talent and keeping them motivated. I think a significant turning point for us was in 2014, and even earlier, right back to 2004, when the pension reform started. I think with that and a move away from a gratuity payment, there was a need to offer an assurance of a good exit for executives. And that's the reform around that and the developments around that are also significant. When I referred earlier to the challenges in this part of the continent and in Nigeria specifically, I had in mind the infrastructural challenges we face. So, for instance, we do not have a good public transport system. We do not have reliable power supply. So incentives around that, such as executive cars, fuel allowances, domestic staff, including drivers and car benefits, power generators and maintenance, those sorts of things remain relevant in executive compensation in this market.
And I would imagine that Southern Africa would be no different, Martin, in not being left behind on that total reward spectrum.
Very much so, Norma. So we used to have simple share option plans, which evolved to share appreciation right plans. Now we have performance shares very much like the UK LTIPs and the US PSUs, with all the discussions around performance measurements, etc. It's a very highly governed regime in South Africa with a governance code called the King Code, which is incorporated in our local exchange, the JSE's listing requirements. There's also detailed disclosure requirements in our Companies Act and some recent changes and amendments that Lenja will go into in greater detail, provide some very detailed both executive disclosure and emerging practices of pay gap disclosure. What's the difference between what's paid at the top and the bottom, which in our market is a very highly controversial and well-ventilated matter. So a lot of shareholder say on pay. We do have, up till now, we've had non-binding votes on remuneration with significant consultation consequences of votes below 75%. That is moving shortly, as soon as this act gets finally implemented, into binding votes, which will, I think, be one of the first African countries having a binding vote. We've also had a significant degree of worker ownership ESOPs to complement the executive share plan. So as Zofa Rainbow mentioned, the whole equity exposure of workers and executives in line with the shareholders is at a great degree of traction. And that's been very incorporated in South Africa's journey of transformation, empowerment, and sharing the spoils better with previously disadvantaged folks in our country. We're very highly governed, let's put it this way. In South Africa, extremely detailed disclosure, which has its own risks, compared to much lower degrees of disclosure, different sorts of governance, probably less shareholder activism in some other African markets. So interesting dynamic tensions, interesting challenges as to should some markets improve their governance and disclosure, should South Africa maybe rein in some of the very intense governance we have to make sure we don't become uncompetitive in executive pay, particularly listed company governance.
Indeed. Thanks, Martin. And I think you raise a very important point around the issue of reward governance, because the prudent enhancement of reward governance and reporting standards become essential for fostering global investor confidence, without necessarily deterring top talent from joining and thriving at companies across our very vibrant continent. So that being said, I'd like to invite Lenja into the conversation to take us through the regulatory landscape in the Southern Market region And just in terms of the key highlights that we are seeing and the changes based on employment and remuneration that will then govern and legislate this particular area. Lenja?
So, as Martin indicated, in South Africa, we have a pretty strong legal framework when it comes to how companies pay and report on executive remuneration. But obviously, the exact rules depend on what type of company we're talking about. So, is it a publicly listed company or private company? Is it profit or non-profit? But as a starting point, the key law here is the South African Companies Act of 2008. Under this act, companies can pay their directors' remuneration provided that it is in line with the company's own constitutional documents and provided that shareholders have approved these payments in the last 2 years. Now, if the company is listed on the Johannesburg Stock Exchange, to Martin's point, things get a bit stricter. On top of the Companies Act, they've got to comply with the JSE listings requirements and King IV, which is a binding corporate governance guideline by virtue of it having been incorporated into the JSE listings requirements. These rules require companies to be really transparent about how they're paying their executives, what their remuneration philosophies and policies are, and how they are implementing these in practice. As things currently stand, they've got to publish a remuneration report every year that explains their approach to pay, along with a detailed breakdown of what executives are earning. As Martin indicated, shareholders do currently have a say in this, insofar as they issue a non-binding advisory vote on the company's remuneration policy and report. And as he indicated, if at least 25% of those shareholders aren't happy with it, and their concerns are reasonable and legitimate, the company has to engage with them to address their concerns. This obviously has a reputational implication for companies at the moment when they don't pass those non-binding advisory votes, but the legal implications of that aren't as severe. Now, there are big legislative changes on the horizon. As Martin indicated, the President of South Africa recently signed into law the Companies Amendment Act of 2024, and we're still waiting for the exact date on which it will come into effect to be announced. But once it does come into effect, public and state-owned entities will have even more detailed disclosures about pay to make. For example, companies will need to reveal the pay gap between their highest and lowest paid employees. So this is really the first instance under South African law where there is a focus on the vertical pay gap and disclosures on vertical pay gap. They'll also need to get binding shareholder approval for their remuneration policies every 3 years. So no longer a non-binding advisory vote. Ordinary votes of 50+1 are required for the remuneration policy. And then also the remuneration report gets a lot more onerous. Again, the remuneration report, often what we refer to as the implementation report, now would have to be approved by 50% of the shareholders. And if it isn't, there are very serious consequences that arise for the non-executive directors who are responsible for remuneration matters, and they could face really real legal and reputational consequences. For example, if the report gets voted down by shareholders, they would have to stand for re-election to the Remuneration Committee. If it is rejected for a second consecutive vote, they could be barred from serving on that Remuneration Committee for 2 years and would have to stand for re-election to the board. This does pose the question of how willing are non-executives directors going to be to sit on these types of committees when the consequences are so severe, and also where it has been imposed, on specifically remuneration committees, and the same consequences don't necessarily exist for other subcommittees of the board. Martin, I don't know if you have any views on this.
Yeah, absolutely. And it's been interesting to see what's happening in the developed market. We've recently seen some communications from the Influential Investor Association in the UK saying that perhaps REM governance has swung too far and is too scrupulous in the United Kingdom, now meaning that it's so much more attractive for executives to apply their trade in the US. And there's some swinging of the pendulum back to actually thinking about retaining and mobilizing executives to deploy their trade in your country rather than somewhere else. So if we look at the growth of our various regions, the East African region, the West African region, North African region in Africa, South Africa could become uncompetitive to apply your trade if there's too high a swing On the counter side, and as Norma well articulated, if your stock exchange and your market is well governed and there's a lot of transparency about executive pay, then there's maybe some comfort of global investors to invest in your market. And I definitely think that is an opportunity for some of the growth exchanges on our continent versus the Nairobi Stock Exchange and the Lagos Stock Exchange, which are very dynamic, exciting exchanges, but definitely have much, much lower degrees of governance and disclosure. And I think in terms of South Africa being very highly regulated, many of the other markets being much less regulated than the developed world, there's an interesting journey in terms of, and I think, Norma, you said the prudent way and finding the balance between truly looking after executive and investor interests, so they really want to invest in our region and in our stock market, which has all the concomitant benefits for the economy, with not being so onerous that no one wants to serve in a public company anymore. They'd rather go to a big private company or rather move to Nairobi and ply my trade there. So interesting journey on this way.
Interesting indeed, Martin. And I think before we move over to Ozofu, who'll probably give us similar insights on the CAMA piece of legislation, perhaps Lenja, how does employment law also then contribute or exacerbate this particular issue that we are looking at, both from a regulatory and talent perspective?
As I mentioned, the issue of pay gap disclosure has existed in South Africa for several years under the Employment Equity Act. And this act says that where employers are designated employers, so this would be those with 50 or more employees, or whose turnover exceeds specific thresholds, they're required already to report on pay gaps to the Department of Employment and Labour. And this would include submitting an annual employment equity report, which highlights any income disparities between employees in the same job category. So what is different here is that companies need to include a remuneration gap analysis that looks at employees performing the same or similar work on the same level, and it looks at differences in pay gap across race and gender groups, as opposed to the vertical pay gap. So I think what would have been nice to see in this lead up to the promulgation of the amendments to the Companies Act is a bit more integration and alignment between these existing reporting requirements under the Employment Equity Act and the Companies Act, so that the information arising from that can be integrated and maybe puts broader social purposes informing things like the living wage and minimum pay and things like that.
Thanks, Lenja. And also for the CAMA Act?
Yes. So here we call it the CAMA, just for short. That's the Companies and Allied Matters Act, which was reenacted in 2020. So one of the things it does, it's really the main law that talks about remuneration of directors primarily, and there's a new provision that references management. So what it requires is that the remuneration of directors is determined by the shareholders, and while the remuneration of the CEO, which the CAMA calls the managing director or the MD, is determined by the board. But in practice, what tends to happen is that the shareholders authorize the board to determine the remuneration of directors. So it would be the non-executives on maybe the remuneration committee that would recommend and then have it passed, led by the chairman, and then for the managing director as well. So while the law suggests that the shareholders are actually the ones approving director remuneration, in practice, it tends to go back to the non-executives on the board. For management, since 2020, there's been a requirement to disclose at the annual general meeting what the pay for management is. But what we've seen done in practice is just that a lump sum is disclosed and not actually disaggregated to show you what each director or each member of management is doing. So I don't know that the disclosure that was sought to be achieved is being achieved, and we might see regulations coming down the line to create greater disclosure. There's certainly no pay gap disclosure requirement currently in Nigeria, so that doesn't exist. There are other things that the CAMA provides for, such as the right of a director to be reimbursed for expenses incurred in the discharge of its duties, there is a general prohibition on companies providing loans to directors or guarantees for loans or security, any form of, loan or assistance to directors to obtain a loan. But those restrictions don't apply where the company's ordinary course of business is to grant loans or guarantees. So for instance, in a bank, because that's what the company does anyway, they can give loans to their directors. For non-bank organizations, what we tend to see is that they apply these restrictions to NEDs, but the EDs, the executive directors who are employees, are treated as other employees. So I'm aware that they do get loans as well. The CAMA also prohibits companies from making payments to directors for loss of office or for any sort of consideration for their retirement unless the company has approved the particulars proposed. So you could have in the agreement, the retirement package for the executive. And so he probably will get something for leaving office. It wouldn't be called loss of office or retirement, but there are ways to structure that so you don't breach the law. So I think in summary, there's still a lot of flexibility. Employment law isn't over-regulated in Nigeria. There are several who think it should be more regulated, but I think for now, there is certainly more flexibility than Martin talked about in Southern Africa.
Thank you, Ozofu. And these are absolutely interesting contrasts. And Rainbow, perhaps from an East Africa perspective, is there a middle ground here because we are sensing the over-regulation versus the minimal regulation over disclosures. What's coming across from a Kenyan perspective, from an East Africa perspective, particularly underscored by the Finance Act, and also seeing a lot of the Social Health Insurance Act coming across in the media? Insights from your end, Rainbow?
When we look at private entities, there is very little governance in terms of disclosure. And we are seeing a lot of changes in legislation that have had an impact generally on employment law. So employment law in Kenya it's very employee friendly, generally speaking. So we do see a lot of litigation related to termination claims, etc. But when we talk about remuneration, you mentioned the Finance Act, and that included a mandatory housing levy. So we've seen quite a big increase in various taxes in the last couple of years. So one of them was this housing levy, which talks about a 3% mandatory levy, and the employee contributes 1.5% and the employer contributes the other 1.5%. The problem that we've seen with that is we're not sure when we're actually going to see any of this housing. So it's caused quite a lot of concern amongst the population. And you mentioned also the Social Health Insurance Act, which was brought in 2023. Prior to that, we had the National Hospital Insurance Fund Act, which established the National Hospital Insurance Fund, and that was a mandatory contribution as well. Now, actually, the Social Health Insurance Act, which we call the SHIF, it amended the NHIF Act and introduced distinct funds. There was a Court of Appeal decision recently which granted a stay on the execution of the High Court's judgment from July this year, because earlier the High Court had held that the provisions of SHIF were unconstitutional. Now, due to this stay on the execution, people are now expected to register with the Social Health Insurance Fund and make contributions from the end of next month. Now, the problem that we've had is that it is a lot more expensive than the National Hospital Insurance Fund. So we've also seen a lot of unrest with the general population. And even, looking at executives, the contribution has gone from something relatively low under the National Hospital Insurance Fund Act, which was about 1,000 shillings or between 1,000 and 2,000 shillings. And under the SHIF, it's going up to about 27,000 shillings. So it's making a big difference on people's remuneration, and obviously it's caused a lot of unrest. We've seen from a general employment perspective an employment amendment bill which has been proposed, and that has highlighted the employee's right to disconnect. It isn't enforced, but it's showing how space is moving in Kenya and across East Africa, with allowing employees that right to disconnect and not being reprimanded for doing so. As I mentioned earlier, the Companies Act is our guiding piece of legislation for companies in Kenya. It doesn't provide guidance on ESOPs or LTIPs for any of the private companies. So it's a very flexible arrangement here, and companies can pretty much do what they like if they are unlisted. And then the Capital Markets Authority governs the provisions for listed companies, and there are specific structures. If listed companies want to set up an ESOP, it has to be in a very specific format. As Ozofu mentioned, the reference to the pay gap disclosure, and unfortunately we also don't have that here. So the disclosures compared to South Africa, it's very, very limited.
So the ease of doing business across the African continent varies throughout this perfect landscape that we have. And Rainbow, you mentioned a very important point around the governance of ESOPs and LTIPs, bringing us to an important conversation around talent retention, specifically your executive remuneration space, specifically with your key and critical skills. And perhaps let's hear from Martin in terms of what these emerging trends are and how we are retaining our key talent and our executive talent.
So in terms of attracting and retaining executive talent, we have major constraints on what shareholders are prepared to support. So if you use the R word, retention, in any of your executive policies, you are likely to get investor issues, because the premise, which has probably got quite a lot of credence, is executive pay in South Africa is very high, must be related to performance, so that should be sufficient to attract executives into your market. Below the dizzy heights of the directors and prescribed officers of our listed companies, there is some more flexibility beneath that area where you don't have to report on the details of what gets done. You do have to provide the principles, and you have to give investors assurance that you are looking at performance of individuals. You're not just rewarding people for sitting at their desk and twiddling their thumbs. But there is some more flexibility there. In terms of retaining talent and acquiring talent, obviously you have a lot of flexibility with the quantum of what you pay. So you can pay really talented people with attractive skills significantly higher, and that is permitted in our markets. Whilst equal pay for equal value of work is an important tenet, well legislated one as well. There are valid differentiating grounds to pay people more, providing that the value of their work is higher. So it needs to be demonstrated that they have the skills and the performance that generates better value than their colleague who might not have the skills and might not be performing at the highest level. So our high-performing people, we can make provisions to pay them more. The quite attractive tool of that the US market uses of restricted shares or restricted stock, as they call it, has limited ability in South Africa, because we are restricted from granting those sorts of shares to our top executives without any kind of performance conditions, just retention conditions. And really it's deferred bonuses where we do get the ability to award these more attractive type of shares, where as long as the company and the executives perform, get an incentive for the year, that a significant chunk of that can be deferred into shares, which they invest only on the basis of continued employment, and in some cases some underpin of at least reasonable performance from themselves and sometimes their company.
Thanks, Martin. I think it's becoming quite key to have these tools for attracting and retaining key talent. And Ozofu, Perhaps if you could also just touch on the popularity and the traction that this is gaining in the Nigerian market, particularly with the migration of talent outside of the country. Is this still prevalent?
Oh, certainly. It's still very prevalent, and I think it's exacerbated by the fact that I think over the past few years, things with the devaluation and the inflation, it's been tougher. Also, I think the fallout from COVID, remote working has encouraged not only the migration of professional talent out of the country, but also for those that remain, employment opportunities with organizations outside of Nigeria has also influenced the competition for talent and what employers have to offer in order to ensure that they keep their best talent. There's the ESOP, which has been around for a while. So usually for management, it allows them, and sometimes it goes beyond management, to all employees or employees beyond a certain level or haven't achieved a certain level of retention in the company, to obtain their shares in the company where they work with a view to becoming part owners. The CAMA, Companies and Allied Matters Act, which I referred to earlier, creates an exemption from the restrictions around financial assistance to enable a company to fund either fully or partially the subscription by the employees of shares in the company to fund an employee share option scheme. So that's very useful because you can offer that to employees. Sometimes the employee pays a below market value, but in some schemes, they don't pay any cash at all. It's all sweat equity. And that helps to provide an incentive for employees. Also, the retention bonus. So the way the retention bonus would feature is that there would be either a fixed amount or a percentage of remuneration payable on the anniversary of the employment over a period. And then there's also the performance bonus, which is tied to KPIs and performance targets being achieved and funded from a bonus pool for that purpose. But there's some regulation. Like I said earlier, there's not a lot in the law that regulates these sorts of remuneration structures, but there are increasingly regulations coming in through corporate governance codes. So the most general corporate governance code we have is the Nigerian Code of Corporate Governance that was issued by the Financial Regulatory Council of Nigeria. It applies to all public companies and all private companies that have a regulator. So I'll call it the NCCG for short. The Nigerian Code of Corporate Governance requires every company to disclose remuneration policy in their annual report and prohibits the executives from being involved in determining their remuneration. It provides that executive remuneration and rewards should be linked to individual performance as well as corporate performance beyond the short term and give executives incentives to perform at the highest levels. It requires companies to implement a clawback policy, which is unique. We've never had that before. A clawback policy to recover excess or undeserved rewards, such as bonuses and incentives, stock options, and all that. And the clawback is triggered if the financial performance on which the reward was based is later found to have been materially false, misstated, misleading, or erroneous, or in instances of fraud or misdemeanor, material violation of company policy or regulation. And the NCCG also recommends that a company's corporate governance report must include cases of clawback where that happens. Maybe just to round up on this point, there are sector regulatory codes as well in banking, for the Securities and Exchange Commission for all public companies, in insurance and pensions, and you see some of this trickle through in the regulatory codes for various sectors.
Interesting indeed. And I think with the inclusion of these sophisticated remuneration provisions for your malus and clawback and your minimum shareholding requirements, as Lenja is very familiar and versed with, it becomes quite a balancing act between being a deterrent versus protecting company and shareholder interests. Lenja, any insights from yourself?
So similar to what Ozofu has said about Nigeria, there is a standard and increasing practice with listed entities to adopt malus and clawback provisions. This largely arose in the financial industry, but it has been also strongly recommended by the King Governance Code. And it is also increasingly being adopted by private companies, which is interesting. So there is a trickle-down effect to that. To your point about striking a balance, it is sort of a carrot and stick approach because, the provisions of those policies are intended to align employee and shareholder interests. And objectively, those two parties should be working towards the same ends. In practice, we have seen, quite a lot of executive concern and pushback about how those provisions are going to be applied and what the consequences of those are, particularly for clawback. That's a very punitive measure. It's actually, recouping payments that have already been made to executives, often long after the event of one of the trigger events having occurred. We have very little case law in South Africa on whether what the outcomes and how courts will treat malus and clawback. So, it is quite theoretical at this point. It is based on, international practice in the US and the UK. But really how that is to be treated by courts, if it is to be challenged, still remains to be seen.
Thank you, Lenja. And I think in rounding up this conversation around retention of key and critical staff, Rainbow, perhaps just closing shots on retention bonuses, key man provisions, and these pieces of legislation which then try to protect all of these transactions.
Do you know, it sounds very, very similar to a lot of what Lenja and Ozofu have mentioned, although compared to South Africa, the regulation in East Africa is much, much less. So we still have a lot of flexibility when it comes to retention strategies. We do in Kenya have our equal pay for equal work premise, of course, but there is a lot of room for movement around that. So we do see a lot of very highly paid executives. We do see a lot of the ESOPs and the LTIPs, both in listed and in unlisted entities. The capital markets collective investment schemes regulations provide for how an employee share ownership plan must be structured for a listed entity. But for the unlisted entities, you can pretty much do what you want. When it comes to the malus and clawback provisions, we're definitely seeing an increase in entities that are based either in the US or the UK and are setting up shop in East Africa. But for the Kenyan-based and East African-based entities, those provisions are not very common as yet. We are seeing an increase in retention bonuses and signing bonuses as well, which in the past were not very common at all.
Thanks, Rainbow. And on that note, I must then call on our doyens of mergers and acquisitions to really give us insights just in terms of remuneration and the role thereof, specifically when you're looking at your corporate transactions. So, Ozofu, from a Nigerian perspective, from a West Africa perspective, any insights there?
There are some interesting insights to share. So where there is a transaction that involves the transfer of the whole or part of the undertaking, the property of a company, the shares, the ownership, where it's proposed to make a payment to a director to compensate him for loss of office or for retiring, that payment is unlawful unless the details are presented to the members of the company and approved by them. So in that context, you can make payments to directors for loss of office, but you must disclose fully to the company and you have to get their approval. So where such payments are part of the deal, it will need to be presented in the notice and memo that goes to the company so you get the approval at the same time. Yeah, this is an approval right. There's another provision. That provision I just referred to is in the Companies Act as well, like the other thing that I mentioned in the course of this discussion. So the CAMA also requires that where there is a transaction that involves a general offer to shareholders to buy their shares. So that would be, for instance, a scheme of arrangement or a takeover offer, any transaction of a similar nature, or where a company is seeking to buy over another company and make it a subsidiary, or where a person is seeking to acquire up to 1/3 of the control of a company, or similar transactions, and there is to be a compensation to a director for loss of office or retirement, it is the duty of the directors to do all that's reasonably necessary to ensure that all the details of the proposed payments are disclosed. So I guess the difference here is that the company is a target of an acquisition by an external party, and that party is offering compensation to the directors that it doesn't intend to retain. So in that situation, because it's not the company itself making the offer to the directors, the obligation is one of disclosure. So it has to be disclosed as part of the terms of the deal, but there is no requirement for shareholders to approve. I've seen some deals where the acquirer had offered some sort of incentive to the executive team to assist in, helping to get the deal over the line. I think such packages are in a gray area here regarding disclosure and could certainly raise issues of conflicts of interest. There's not much more to say on that, but I've seen it happen in maybe 1 or 2 deals. It's not common, but it definitely sometimes exists.
Indeed. And I think, Rainbow, from Kenya and East Africa perspective, in retaining these key employees in the context of these M&A transactions and these private equity deals, I know that there's a lot of work that you've been involved in, just in terms of ensuring that labor law is upheld and, of course, understanding the dynamics of the automatic transfer of employees from one employer to another. Any additional insights there?
Actually, in Kenya, we don't have any automatic transfer of employment under our labour laws. So if there is a transfer of business and assets, the employees will actually be declared legally redundant. Now, there are ways around making those employees redundant if the acquirer would like to take on those employees. So some of the options are either to have the seller declare everybody redundant and then the acquirer handpicks the employees that they wish to retain. Or another way of structuring it is to have a tripartite agreement between the seller, the buyer, and the employees. We're actually seeing a move away from your traditional share purchase arrangements towards a business and asset transfer because of the buyer's ability to effectively handpick the people that they want to keep. That has changed certainly in the last few years, and we're doing a lot of work on business and asset transfers. And of course, if you're looking at a share purchase arrangement, then the employees just retain their employment because the shares are being sold. But in most of the M&A transactions, whether it is a share purchase or a business asset transfer arrangement, the senior executives with the customer relationships, product knowledge, etc., it is a priority for the acquirer. And then circling back to those retention bonuses that we mentioned earlier, we're seeing a lot more of those.
Extremely prevalent. And Martin, I know in the South African context, we've even coined the term Remuneration because of all of these incentive structures that take place when we are looking at these mergers and acquisition transactions. Give us insights in terms of the various schemes that you are seeing being developed, particularly to address the challenges or perhaps facilitating these transactions.
So the first point of entry into transactions are these very large corporate transactions, sometimes offshore buyers acquiring and delisting South African companies, sometimes a couple of giants trying to acquire or merge. The trigger there is, two things. You do have the retention issues of people looking at the future and saying, well, my job is more uncertain. Maybe I'll start thinking of jumping ship and not helping get the transaction across the line. So there are some precedents to pay retention awards in cash in advance of transactions to make sure people stick around at least to the transaction, and then also to avoid the sort of conflict of interest element for sometimes 12 months beyond the transaction. So those are simple cash awards, and those are seen. The other point, which is really interesting and becomes sometimes a critical matter in terms of getting the transaction across the line at all, is how the outstanding share awards from the existing company's share schemes are treated. And there are principles of governance, and there are also rules in various Companies Act and similar legislation that must be observed, but also the rules of the share plan that will generally have provisions for these sorts of transactions, as Ozofu mentioned, schemes of arrangement, other forms of takeover and delistings. Those are embedded in the change of control and other adjustment provisions of the scheme rules. So we often get involved both from remuneration practitioners and our legal colleagues in terms of advising on the black letter law implications of those rules and all the other legislation. Those are fully complied with. And there are also very important employment law matters that come in that employees generally can't be prejudiced by these arrangements. So they obviously can be advantaged to some degree, but if they're gratuitously advantaged, then shareholders get upset as well. So most of these things where there's something extra in it for the employees are generally negotiated between the acquirer and the target company, and we play a role often in facilitating those deals, talking to the legal advisors and the transaction advisors on both sides and coming up with something which is fair and reasonable to shareholders. Then on the private capital side, these things are very interesting in terms of, again, retaining executives and aligning them with their private shareholders, where those private shareholders, they might be evergreen, long-holding shareholders, but they're often private equity funds, which have a build-up of value and an exit of their position. And then we often put very interesting plans in place, which have a strong M&A and ownership element. So mainly to align with medium to long-term shareholders' interests, and particularly with an exit or a liquidity event, which might be a sale to another party or a listing. So there we have structures such as preference share funded buy-ins. We have quite an interesting type of complicated option called an outperformance option, which works quite nicely. And also types of B shares, which where the dividends replicate sort of carried interest economics. Those are done in a proper equity instrument case, and there's some interesting tax implications of that, which our tax colleagues assist on. But then also we have, let's say, phantom or cash-settled versions of those, which are effective if the underlying businesses have good taxable income. So they're not startups which have low taxable income, and they're not investment holding companies or funds where they don't have taxable income from their business transactions. So we get involved in a proper corporate finance type process of drafting the structures, implementing the SPVs and the agreements, and closing it with all the discipline of an M&A transaction. Other elements where we get involved is listings, where both as IPO awards are often structured and awarded with all the things which make the company being dressed up for listing attractive to the incoming shareholders, whilst helping the cash flow of the exiting shareholders. So that's an important thing to look at as well. Then obviously a well-constituted plan that shareholders that are coming into the company, the incoming shareholders, are happy to support for ongoing issue of, as we said, these sophisticated long-term incentive instruments in South Africa. Just the last point where we have M&A style inputs is the ESOPs, where we create structures to hold shares for the benefit of workers, and those need to comply with two sort of flavors of regulation. The one is our broad-based Black Economic Empowerment Act, which assists with transformation and empowerment in South Africa. And then also, in terms of our Competition Commission rulings, they often require an ESOP being put in place with some slightly different objectives. They like evergreen schemes, not finite term schemes. And those are also a very important part of our interaction with our M&A colleagues.
So remuneration on the continent has progressed beyond the transactional employment relationship, more towards a strategic lever in driving business objectives on the African economy. Lenja, the future of remuneration in our continent. Any thoughts on that?
I think from what I've heard today, something that strikes out for me is really striking a balance between enhancing governance around how companies reward their leaders in a way that isn't overly restrictive to accommodate emerging markets, but that are also, well-rounded enough to be able to attract foreign investment and top local talent and give them the comfort of knowing, that there are regulatory frameworks in place that will be adhered to as well. I think it is very exciting to hear what's happening on the African stock exchanges. I think there's a wealth of opportunities there. South Africa has seen some stagnation on its stock exchange. About 20 companies delisted from the JSE in 2022 alone, but other markets, African markets, are on the rise, and the number of stock markets across the continents today has shot up to about 18, as opposed to 5 in 1990. I think it's really about exploring these transnational cross-territorial opportunities and maybe learning from each other's experiences and practices.
And I think, Rainbow, with your expertise on cross-border transactions, your views in terms of where we headed as a continent and our remuneration.
From an East African perspective, I think we could be looking for more stringent governance requirements, hopefully not quite as stringent as the South African space, but I would expect to see some changes to our requirements in Kenya and potentially across East Africa, opening it up for more transparency and greater reporting requirements. Circling back to the very initial discussion about the disclosure requirements under the Code of Corporate Governance Practices for the issues of securities to the public, it's very, very limited. And when you compare it to what Martin and Lenja have outlined, I would like to see some greater structure there and more transparency across the board, not only for listed entities, but also for the private organisations. I think we'll also see in the M&A space an increase in pre-closing requirements for establishment of ESOPs and other incentive-based structures as part of the M&A transactions. But like Lenja said, I think it's a very exciting time for the continent and look forward to being part of it.
Absolutely. Ozofu, are we seeing flexibility into the future or perhaps an increased regulation and disclosure requirements? Where are we headed on the West?
I think that I'd probably lean more towards greater flexibility. I think it's just because of where the market is right now. It's a good time to be an executive. The competition for talent is fierce and it is global. So it means that employers are competing against global peers for the best talent. And I think in order to compete properly, you need to have flexibility. I think for maybe just from Nigeria's perspective, we have a predominantly youthful population. That combined with the challenge of migration of professionals to greener pastures in quote, we expect to see more flexibility around structuring packages, to respond to what appeals at the moment. For instance, we constantly in our employment team answering questions around the currency of remuneration or benchmarking against a stable foreign currency and how you deal with that with local restrictions. From the M&A perspective, part of our merger control approval process involves more disclosures to employees about the terms of a deal, and it actually constitutes part of the pack we submit to the competition regulator. I will not be surprised if regulations in the future require greater disclosures about payments to executives as part of such deals. I had mentioned earlier currently how the reporting requirements around what directors are paid and what management is paid are not really being adhered to the way I think the law and the regulations envisage. So I won't be surprised if the corporate governance codes go on to be amended in the future to require specific and certainly greater transparency in relation to these packages.
Thank you, Ozofu. And Martin, finally, what is on the horizon for remuneration on this vibrant continent of ours?
I think the cooperation between remuneration professionals and legal professionals and tax professionals in this dynamic and fast-growing continent of ours is really important to play a role in the incredible growth and economic opportunities that we have in this dear continent of ours, and also in addressing many of the challenges. Ozofu mentioned infrastructure challenges, which we've of late been wrestling with, particularly on the power side in South Africa, but amazing to see how human beings in business respond to pressures, and the myriads of solar panels we see springing up to mitigate our power things in a relatively short period of time has been fascinating in South Africa. So I think there's a lot of co-learning that we can have. We've really seen the extremes of the flexibility in Nigeria, the very high regulation in South Africa, a bit of middle ground in Kenya. And I think there's a lot of room for very thoughtful and high-level engagement between remuneration professionals, business people, investors, both institutional and private, and regulators and government in our regions to come up with a middle ground where we can really make it attractive to both retain our people that might be looking at the so-called greener pastures, keep them and attract them to our continent. Because I think if we look at all of the economists' forecasts, our continent is the one area where there's significant growth opportunities. So we need to harness the talent both at junior worker level, at key technical specialists, IP and tech skills, and at leadership levels, where people can feel that they're being well rewarded. It's attractive to be here. And we always have the attraction of coming home to a familiar market, to familiar people, to family, etc. But our deals that we have with these executives need to be at least competitive with the huge pay that's paid in the US, the UK, and developed markets. And I think one of the other big opportunities is really mobilizing these ESOP employee ownership structures in a way which is tax effective, looks after worker rights, and just gets not only the economic benefit of share ownership, but the mystique and the emotional attachment to the company, which we often find this kind of divide between executives, management, and workers is often dysfunctional and leads to below par performance of a company, which affects everybody, all stakeholders. So I think in closing, I think remuneration is complicated, even if we just look to our own markets and challenging enough. It becomes really interesting and even more challenging and exciting when we look at it from a Pan-African point of view. And I think certainly working with our broader Bowmans and Uber team across the continent in framing this first maiden publication of Reward in Africa has been amazing, just to learn a bit more about what's happening in our other areas of Africa, to get to know each other better, to be able to work together to deliver really, really interesting solutions to challenges and seize opportunities with our colleagues across our firm. And obviously delighted to work with good companies in all parts of Africa, indeed regulators and government people, to come up with a Pan-African offering, both to our people, so we can attract and reward our talent, and to investors and shareholders, and obviously all the other stakeholders, the customers and clients of high-performing great businesses in our continent.
These are exciting times indeed. So we are co-learning, collaborating, and growing Africa's fast-growing consumer markets, underpinned by legislative and regulatory frameworks to enhance our foreign investor confidence. Colleagues, it's been an absolute pleasure being in conversation with you. And I invite all stakeholders and listeners of this podcast to have a look at this report, because we believe that it will serve as a valuable resource for business leaders, policymakers, and investors who are looking to navigate and capitalize on the remuneration trends shaping Africa's corporate landscape. And of course, the insights are absolutely informative and actionable. Thank you, everyone.
If you would like to get in touch or find out more about Bowmans, please visit bowmanslaw.com.